Good morning, everyone. You are watching a live market outlook for Tuesday, 13th of December 2011. The overall outlook in the markets remains still quite pessimistic as the European summit deal to strengthen budget discipline in Eurozone basically failed to restore financial market confidence yesterday. That resulted in further weakness of the single currency as well as euro stocks and especially the commodities and especially the gold that dipped to some levels lower, and basically the gold now seems to be losing its safe haven grade as it moves together with the riskier assets. The euro, as I said, fell, and the borrowing costs for Italy and Spain rose as investors wait on the outcome of last Friday's summit that basically split the European Union, as the Great Britain blocked the treaty changed and forced Eurozone countries to negotiate a fiscal accord outside the Union. The initial market rally on Friday was mainly due to the uncertainty surrounding the new pact. However, it was short-lived as the the markets are back, especially the euro and the euro stocks are back to the rails in the downtrend. The French President Sarkozy said the legal basis of a new accord to enforce debt and deficit rules in the 17-nation euro area with the quasi-automatic sanctions and intrusive powers to reject national budgets would be worked out before the Christmas. Some sources said that the first draft of the new treaty would be ready by early next week. As Sarkozy said, the aim was to have it ratified by all member states except Great Britain, latest by June. The investors' appetite for a short-term paper drove yesterday the Italian one-year borrowing costs down just below 6% at an auction, but yields still remain uncomfortably high despite ECB's action that bought approximately 35 million five-year bond yields, and also the bonds are again back above 7%. The yields are above 7%, as this is a dangerous level, while the 10-year yields spiked above 6.8%, and Spanish 10-year yields topped 6%. Further pressure and the black clouds are coming now from the rating agencies, as all the major agencies are likely to make the situation even worse from now. The French President Sarkozy already prepared the French voters for a possible downgrade of the country's AAA credit rating, but it insisted that he could cut the deficit without cutting salaries and pensions. Moody's Investors Service said it intends to review the rating of all 27 members of the European Union in the first quarter of 2012, after EU leaders offered a few new measures to resolve the crisis at their summit last Friday. Fitch Ratings said the summit failed to provide a comprehensive solution to the crisis, thus increasing short-term pressure on Eurozone sovereign ratings. The third one, Standard & Poor's, which warned last week of a possible downgrade of 15 Eurozone countries shortly after the summit, still has to announce its decision. However, the chief European economist told in a business conference in Tel Aviv yesterday that the time is running out and action is needed on both sides of the equation, on the fiscal and the monetary side. If some of the Eurozone AAA rated members are downgraded, it would call into question the solidity of the Eurozone Rescue Fund, which would likely suffer a similar fate. Its permanent successor will not come on stream until mid-2012 at the earliest. The Euro area basically now faces the next potential crunch point in mid-January, when Italy, which has a debt mountain of 1.9 billion euros, I would say 1.9 trillion euros, or 120% of its annual output, has to start issuing tens of billions of euros in bonds towards 2012 total of 340 billion euros needed to roll over maturing debt. The political aftershocks from Friday's historic rift between Britain and the rest of the 27-nation bloc continue to shake Europe, as the Prime Minister Cameron facing tension in his coalition and doubts in the business community. From the other side of the world, the FOMC's meeting due today, with the Federal Reserve likely to hold off offering the U.S. economy fresh stimulus at the meeting today, as it waits encouraging signs on the recovery against risk coming from Europe. Central bank officials are expected to continue discussions on how they might sharpen their communications to get more traction out of the monetary easing they have already put in place, but observers rate chances of an announcement as low. Even less likely is prospect of new round of bond buying, although many analysts think that will happen eventually too. The Fed has held overnight interest rates near zero since December 2008 and has bought 2.3 trillion US dollars in bonds in a further attempt to stimulate a robust recovery. Recent reports about the U.S. economy point to some improvement. The jobless rate tumbled 0.4% percentage point to 8.6% in November, and consumers entered the holiday shopping season with the wallets open. The world's largest economy expanded at 2.5% annual rate in the third quarter, the fastest pace in a year, with forecasters hope growth will top 3% in the current quarter. Back to Europe, the Swiss government on yesterday's meeting cut its growth forecast for next year due to a worsening European economy, but said it does not fear a deep downturn so long as the clouds over the Eurozone do not darken further. It sees growth of 0.5% next year, down from its September forecast of 0.9%, citing a worsening of European economy and its effects on the Alpine states export sector. The Eurozone in Switzerland's biggest trading partner. Also, deflation and recession risks are growing, with Swiss National Bank capping for now the safe haven franc at 1.20 per euro at its last meeting on September 6th, but leaving the door open for further action if the outlook worsens. Some rumors in the markets are saying that the next peg should be around 130 level. Tomorrow is the meeting of Swiss National Bank regarding the interest rates, so we will see what will be their action. From today's calendar, a number of events due to come soon. At 9:30 GMT we have a UK's inflation that is forecasted to drop to 4.8% compared to the 5% previous month release, as well as core yearly CPI that is forecasted at 3.3% compared to 3.4% previous release. Retail price index is also expected to drop to 5.1% versus the 5.4%, the previous month release. Some expectations from this morning comments of the analysts see if in case of stronger and better than expected release today of the inflation, that would be a signal for a further selling higher strategy for the British pound. Further to come at 10 o'clock GMT, German zoo economic sentiment. It's expected to worsen. Minus 56.1 is the figure forecasted for today, compared to minus 55.2% previous release. Also, the Eurozone zoo economic sentiment due at the same time, 10 o'clock GMT, is also forecasted at more negative levels. Minus 60.3 is the consensus for today, compared to minus 59.1 the previous month release. Across the ocean, core retail sales and retail sales from US due at 13:30. Monthly retail sales are expected to show growth by 0.6% compared to previous month, 0.5%, while core retail sales monthly forecast today 0.5% compared to 0.6% previous month release. US business inventories monthly are due at 1500 GMT and are expected at 0.7% compared to unchanged the previous month reading. Federal funds rate FOMC announcement is due at 19:15 GMT, so late in the evening. We are going to have the announcement from FOMC. After the announcement, the FOMC statement will be released. As I mentioned earlier, no change in the interest rate policy, with the rates 0 to 0.25 are expected to stay. Now let's take a look on the markets and see the latest 24 hours movements in the market. As usual, starting with the euro. As we can see on the 4-hour chart, the euro has accelerated losses after losing 133, 132.80 initial and strong support, actually breaking also below the channel support, which was at 132.50. Loss of 132.11, previous low of 25th of November, and 132.00, the weekly head and shoulders neckline seen on the weekly chart, has so far extended losses to 131.59. This was the low of the day, posted on the early hours of Asian session, just ahead of next critical support at 131.45, which is the low of 4th of October, and the break here would signal a fresh leg lower, part of a broader downtrend of the euro dollar, and end of a corrective phase that started from 131.45 and was capped at 142.46 on 27th of October. Loss of the 131.46 would likely in the short term open way towards 130 as strong psychological support. On the upside, not much expected to see, as the pair is currently correcting on the oversold hourly and 4-hour studies. 132.80, 133, where also comes the 20 days simple moving average on the 4-hour chart, for now is expected to limit the upside attempts, with initial resistance at on a broken bear trend line and channel support currently at around 132.40 zone. Only break, firm break above 133.80, 134 would bring some more positive tone in the pair's current action, although with the current outlook of from the fundamental side, this is quite unlikely to happen, as no more shock therapy is seen in the near future. So we assume that the current negative tone is going to persist in the short-term price action for euro-dollar. The cable is back to its previous 155.60, 157.70 range, despite yesterday's brief break below the low of 155.60 of 6th of December, also the range floor. That dipped to 155.36, just ahead of our next support at 155.25. A quick recovery back to the range as so far been capped at 156.56. This was in yesterday's early afternoon hours, just short of 156.60, our initial resistance. However, the dips were contained above the range floor. With the current strength underway, I don't expect much to see, as for now likely 156.60 resistance zone might stay out of reach for now. However, the near-term studies, hourly studies, are entering the positive territory, and the pair is gaining momentum. Basically, break above 156.60 is required to signal some stronger recovery. But as long as the recent highs and the range ceiling at 157.70 holding, not much to expect. Then further directionless movement within the current range. On the daily chart, the outlook is still into the more negative, as 55 days simple moving average caps the action upside, as well as Fibonacci retracement 38.2% of the uptrend from 154.22 to 157.77. And as long as these levels are intact, the broader downtrend of the pair would be dominating. Critical support at 154.22 would be seen if the situation on the near-term outlook worsens in case of loss of 155.36.25, and then round figure support at 155.00. That would likely open way towards 154.22, 25th of November low. The dollar yen is this morning again losing strength after initial rally from 77.50 support zone, broke above the main bear trend line drawn of 78.27 high of 29th of November, extending gains towards 77.99. So just touching our initial and strong barrier at 78.00. Some consolidation followed overnight. However, the pair is now losing traction and traveling again lower, currently attacking 20 days simple moving average on 4-hour chart. That is initial dynamic support. Holding above this level would still keep the prospect for a fresh attack higher, as the studies are still in the positive territory. However, the pair is currently losing momentum on the 4-hour chart. Loss of 77.70 opens next strong support at 77.50, below which would signal that the pair is back to the bear channel of 78.27, with the levels at 77.28 and 77.12 ahead of range 77 as a figure support, and the 76.87 channel floor to come in focus in case of break. So the points to watch now is first attacking currently at 77.70. If the pair reverses at this point, that we might see fresh rally higher, as also the near-term trend line support actually has been broken, so this is weakening the structure. Holding above 77.70 is to keep the focus at 78.00, while loss here to focus 77.50, our next strong support, loss of which weakens the structure and resumes lower. The dollar Swiss is currently consolidating the yesterday's strong rally that cleared the previous first congestion area at 93.00, then previous highs at 93.13 and 93.28, extending gains close to 94.00, our next figure resistance, hitting 93.86 so far. The 4-hour and hourly studies are still into positive territory. However, loss of momentum on the hourly chart sees scope for a corrective pullback, as the RSI was in the overbought territory, on hitting the 93.86 high. Initial support and the current overnight consolidation range floor at 93.60 has now been lost, with the further extension towards 23.6% Fibonacci retracement of the latest up leg from 91.79 to 93.86 seen as first, with the previous resistance at 93.28 coming next. This is now reverted to support. On the 4-hour chart, I would say that holding above 93 zone, which is also close to 38.2 Fibonacci retracement, would be supportive for the pair and would keep actually the current bullish tone intact for a fresh leg higher, and the clearance of 94 to open initially 94.50 ahead of psychological figure resistance at 95.00. That is seen as our next target. Only loss of 93 handle would be near-term bearish and would signal a stronger correction before the bulls reassert, as the broader outlook remains firmly bullish, as shown on the dollar Swiss daily chart, where the 20 days moving average holds the downside and maintains the latest uptrend. Now to the commodities. As we can see, the gold has lost traction completely, losing 1700 as initial support, breaking below the short-term trend line support at 1690, losing also the supports 1672 and 1666, with the 1650 seen so far. On more the near-term studies are deeply into negative territory. However, the oversold conditions on 4-hour charts are seeing a potential for a corrective, stronger correction, with initial resistance at 1672, the previous higher low, coming as first, and then 1690 broken bull trend line next. For now, 1700, the previous strong support zone, is expected to limit the upside, as 20 days simple moving average currently at 1696, pointing lower and maintaining the recent downtrend, expected to cap the corrective attempts. On the daily outlook, also the worsening situation is worsening, as the MACD is breaking below its midline, loss of momentum and break of the triangle support at 1660 now opens way for a possible extension lower, and to test of first 200 days moving average that currently stands at around 1617, ahead of lows at 1600 and 1582. A loss of 200 days definitely, the moving average definitely would weaken the daily structure as the pair remains in the downtrend from pardon 1920 record high, with the downtrend, with the bear trend line drawn from here, connecting the next highs at 1795 and the 1756, currently capping the upside. The crude oil also reversed after unable to hold gains and break higher from 100 to 42 high of 5th of December, losing the initial array of supports at 130 and the psychological support at $100 per barrel, extending losses to the next strong support at 97 2030 zone, also close to 61.8 Fibonacci retracement of the upleg from 95 to 102.42. The Paris, the current price action sees attempt of basing at this level. However, the upside attempts were capped just ahead of our stronger resistance psychological barrier at $100. With the outlook currently still in the negative territory, and the 20 days moving average currently at 98.60, maintaining the downtrend. I would say the firm base here to be formed, the break above 100 is required, and focus to bring focus up to 102.42 and the 103.35 highs. Loss of this platform at 97.30.20 would signal further easing of the oil price and the open way towards our next strong support area at 95.00.